So Bitcoin is down, but it's our clients. It's actually not a surprise to our clients because Mark Newton, our head of technical strategy, really pointed out the cycles in mid-January that he was targeting 62,000 for Bitcoin by the end of March. So we're actually on our way to 62, but that's not a bearish development. It's just a retracement. And the third, of course, is small caps, because once the tariff talks go away, the environment is favorable for American-focused companies, which would be, small companies, and they'll benefit from lower rates and their multiples are lower. So I think it's still a big opportunity. But in the middle of tariff talks, none of these groups can really do that well. To me, is 62,000 a reason to turn bearish on Bitcoin? I mean, if you're trading it, yeah, but Bitcoin was $1,000, $100 10 years ago. Mm-hmm. So, 60,000 is still a fantastic return. And I think Bitcoin's usefulness is still improving.
Despite short-term challenges, famous market expert Tom Lee is unwaveringly optimistic about Bitcoin's long-term potential, although some, such as technical strategist Mark Newton, believe that Bitcoin may fall to $62,000 by March, an expected correction rather than a catastrophic decline. Tom Lee highlights that the cryptocurrency's core value is only increasing. Bitcoin's potential as a sound investment in the upcoming years is unaffected by its increasing usage and growing recognized as a store of value comparable to gold. Bitcoin's limited supply and growing acceptability as an asset class make a compelling case for its future appreciation, even though it is still susceptible to market downturns as a risky asset. Take a moment to like this video, subscribe to the channel, and turn on notifications for more content on Bitcoin and the digital asset space. Also, drop your thoughts in the comments below. It helps with the YouTube algorithm and supports the channel. Thanks, and enjoy the video.
I mean, the market is trying to price in a lot of these uncertainties right now. And so it's understandable that we're churning. But investors don't want to become too bearish because the market sentiment, and it's already measurable, like the AAII survey, which is what we've used for the last 14 years. I think it's the best retail sentiment survey, is at the same bearish levels it was in the fall of 2022. So retail sentiment, and that's probably because there's been a ton of margin calls last couple weeks, is at the levels that were at the depths of that recent bear market. So the investors view this as a crisis when it's really a growth scare. So to me, I think there's a good chance we're making our lows for the first half, like this week. And
like down 5-6%, you mean?
Yeah, it could be.
Yeah.
I mean, the only thing is I'm not that optimistic about the job picture for the near term, so maybe that's one last leg. But the reality is that a lot of bad news has gotten priced in. And, on the flip side of this is that the closer we get to stall speed, the more the Fed has to get off neutral. And I think the White House will have to back off talk of things that could be hurting the economy.
The CPI, PPI, PCI, all the components of inflation that clearly populace is upset about for good reasons because they're paying more for things. Should the market be equally upset?
Well, inflation is a problem because prices aren't going to go back down, and they're up 50% over the last couple of years. And so I think it's going to be harder and harder for consumers to tolerate more inflation. Even if it's still at 3%, it's still going to be unbearable. But if I look at it from a markets lens, I know a lot of people are saying that there's a second wave of inflation underway, or it's picking up and you're seeing it in the consumer surveys. But I think we don't know what the seasonality is. And I think the consumer surveys themselves are actually very flawed right now, and they're picking up less the fact that egg prices are up, and I think more political respondents. Like the UMich survey, there's a huge bifurcation between Democratic views on inflation versus Republican. And the bond market itself is giving very conflicting messages about inflation. In fact, I would say if I looked at what the bond market's saying, I think it's saying there's no problem with inflation. The reality is that if policies are enacted that create such a severe shock because of tariffs, then we could have a recession, right? I mean, that's like a fact. Because if you put a 300% tariff or something, we don't really know how to titrate that number. And that's why investors are nervous. But it's at the same time, the tariffs are accomplishing the administration's goals. Because if I was the White House and I know that I have some opposing risk from the Fed today, because the Fed's hawkishly paused, well, if the tariffs are causing confidence to fall and business activity is slow, then the Fed has to get off neutral. And but then everyone's playing a dangerous game because, as you know, you don't want to get stall speed in the economy, because the day the economy gets to stall speed, we open up the uncertainty of a recession, because, a shallow recession, a recession is unknown once it starts. The best strategy for our clients that we've recommended is you just want to be a long-term holder, but most people don't approach crypto that way. Most are trading it and want instant return. The work by our technical strategist, Mark Newton, so he thinks Solana, Ethereum, and Bitcoin all have downside. He has been bearish since mid-January. So I think it's been correct, and his downside target for Bitcoin is 62,000 by the end of March. But to me, is 62,000 a reason to turn bearish on Bitcoin? If you're trading it, yeah, but Bitcoin was $1,000, $100 10 years ago. So, 60,000 is still a fantastic return. And I think Bitcoin's usefulness is still improving. I don't think it moves. It's still a risk on assets. So I don't expect it to do well if the market is being hit by tariffs. Like, it's not immune to that kind of turbulence. But is the trust around Bitcoin going to grow over the next 5 years? Yes. And is it going to be increasingly viewed as a store of value like gold? Yes, I think increasingly. And then is there room for a lot more people to own it? Yes. So I'm not really bearish on it, but I think in the near term, it's hard to say it should go up right now.
Too much panic. I think that move in December after the Fed meeting, that felt really bad. But we were not making, it didn't take long to make new highs.
Well, I think that July to August was essentially, I would say, Fed driven.
Yeah.
And so that makes sense, because it felt like either the Fed made a policy error or the Fed turned hawkish.
Right.
But either way, we had a big drawdown. Will that happen this year? Yeah, I think it'll happen. If I'm guessing, it's more in the second half. So I think this is just a flesh wound right now, not the source of a drawdown.
Okay.
According to Tom Lee, one of the current market's hidden winners might be financial companies. Banks and other financial organizations have suffered during the past 15 years, mostly as a result of difficult economic times and regulatory obstacles. Lee, though, perceives a change coming. Despite difficult conditions like inverted yield curves and stringent Federal Reserve policy, big banks like JP Morgan have demonstrated remarkable resiliency by continuing to turn a profit. Financial equities may benefit from improved conditions as the macroeconomic landscape shifts. Lee also believes that small-cap stocks have a lot of promise, particularly as the uncertainty surrounding tariffs begins to subside. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
To me, one of the, I think, sleeper winners from all of this is going to be the financials, because they've underperformed the last 15 years. So they really have not caught a break since the GFC. And finally, an environment that is better for the banks, and AI is actually good for business. And JP Morgan and all these banks show they made money through inverted curves, hyperinflation, tightest Fed ever. And now you have all this reversing. Another group that I think makes sense is digital assets. I do think, so Bitcoin is down, but it's actually not a surprise to our clients, because Mark Newton, our head of technical strategy, really pointed out the cycles in mid-January that he was targeting 62,000 for Bitcoin by the end of March. So we're actually on our way to 62, but that's not a bearish development. It's just a retracement. And the third, of course, is small caps, because once the tariff talks go away, the environment is favorable for American-focused companies, which would be small companies, and they'll benefit from lower rates and their multiples are lower. So I think it's still a big opportunity. But in the middle of tariff talks, none of these groups can really do that well. I think that there's a lot of logic to what if Besson's focuses on yield, because we know that you live off what's priced off the yield. So mortgage rates would fall, cost of borrowing would fall. That helps a lot of Americans, but it doesn't mean they want stocks to fall. Right. So I think that people are making that logic leap. I think that the administration doesn't want stocks to go up if there's tough tariff talks, but it doesn't mean that they want the stock market to be down 10% this year, because we know all recession probability models just exactly what you said, Guy, they go up because the largest predictor of recession is the stock market. So if it's down 20%, then all of a sudden austerity has to go out the window. You have to do entitlements and the Fed has to unleash liquidity. And that's the exact opposite of what they're trying to accomplish. So I don't think they really want a down market. They don't want the market to not respect their message right now. One of the reasons we weren't that cautious or expecting a recession is that a recession is often two conditions, not just one. Most people thought, hey, the Fed tightens and Feds are responsible for all recessions because, they say expansions are murdered by the Fed. But really, that happens when the economy has exhausted incremental return on capital. And if we go back to the 2021-2022 period, private investment spending as a percentage of GDP was still near recession levels. So capital spending wasn't exhaustive, and consumers' debt service ratios were still at recession lows. So it was hard for us to argue that the Fed and its tightening, even though it inverted the curve, would be enough of a contractionary pulse to actually push us into a recession. I think the employment picture is going to get pretty messy this year, but for obvious reasons. There is availability workers might be diminishing because of deportations or fears of people getting deported, so there may be fewer people showing up for work. And then DOGE and the changes in how NGOs are being funded, and the austerity from that is going to show up because many of these federal employees are still getting unemployment benefits, so they're not filing claims yet. But I think you're already seeing it in like Washington, D.C. Jobless claims are picking up and Zillow real estate listings are picking up. So I think that there is a spillover already happening. So it's possible that this year in the first half, the job market could be missing consensus by 50% for a while, and it'll get people scared.
Tom Lee talks about how the Federal Reserve's actions throughout July and August significantly influenced the market's performance. He notes that there was a notable market pulldown around that time, suggesting that the Fed either changed its stance or became aggressive. Although Lee thinks the present market decline is really a flesh wound and not the beginning of a more significant slump, he anticipates a similar situation to play out in the second half of this year. He clarifies that although many Americans may benefit from lower yields and declining mortgage rates, the government does not want the stock market to fall by more than 10% because a large market decline might trigger a recession. Lee claims that a steep drop in the stock market may compel the government to undo austerity measures, grant entitlements, and release liquidity through the Fed, all of which would be detrimental to the objectives of the current policy. Lee also mentions that two factors, rather than simply one, usually cause recessions. Although there has undoubtedly been some tightening as a result of the Fed's measures, he contends that consumer debt service ratios and private investment spending were both at recession low levels in 2021 to 2022. He found it difficult to accept that the economy will enter a recession as a result of the Fed's tightening alone. He believes that, in the future, the employment situation might get complicated because of things like a lack of workers and adjustments to federal financing, which might result in an increase in unemployment claims. Lee concludes by pointing out that a steep decline in home or stock prices would almost likely result in a recession, even though declining bond or gold prices might not. He believes that a major collapse in either the stock or housing markets would increase the likelihood of a future recession. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.